Hello, unit members nationwide. My name is George Kaltzidis. I'm studying at the University of Melbourne and I am the president of the unit University of Melbourne chapter. On behalf of our team, it's our absolute pleasure today to welcome Sid Choraria. Sid is a public equities investor with over 15 years of experience across global markets. He has worked at firms including Goldman Sachs in Asia, in the technology, media and telecom investment banking group, before he moved over to funds management and multi-billion dollar firms such as portfolio management and head of Asia roles. Sid now focuses on investing his capital in the world's greatest businesses through a proprietary developed process. Noteworthy, Sid received a rare response from Warren Buffett on an idea he sensed on a Japanese business. He received his MBA from NYU Stern as a Harvey Baker Scholar. Sid's research has featured on CNBC, Bloomberg, Goldman Sachs Alumni Network, touching on topics such as value investing, high-quality businesses, and decision-making. These are all topics that we are excited to cover with Sid today, and with that in mind, I'm very excited to pass over to Sid Choraria.
Yeah, thanks, George, for hosting me. A true pleasure to speak to you and your club. The topic of today's presentation is really how to identify the future great businesses of tomorrow. And so what I'm going to do is just run through some case studies of giants today, but really what they look like sort of 30, 40 years earlier, and sort of some of the ingredients and lessons we can learn from those case studies. So I just fire up my slide presentation and we take it from there. This is a slide just with some key insights. The first point I really want to share is that great ideas are truly rare. And you want to fish in fertile pools where competition is the least. I worked on a proprietary database to track companies globally, which I've developed internally. And I would say my view is that there are about 140 to 170 businesses in the world that truly merit the investor's attention. This is a mix of early growth businesses, entrenched businesses, and less followed companies around the world. These are businesses selling products people need to buy again and again. So really, the goal is hunting for wonderful businesses before institutions love them. These businesses are typically run by founders or management that is obsessed with one mission. People matter enormously in the investment process. Panic is opportunity. One has to be prepared, when being an investor. Time is finite, so you want to focus your time and attention on the best businesses globally. I rely on an extensive use of checklists, systems, to turn rocks 6-7 days a week. The last point I would add is psychology is more important than accounting and brilliance. I'll move to the next slide. As you pointed out in your introduction, I received a response from Mr. Buffett many years ago on a letter, an idea I shared with him on a 125-year-old or now like 130-year-old Japanese business selling products in the local market that people need to buy again and again with significant growth opportunities, in the Asia Pacific market. Here, his response, Sid, it's a good company. We're looking for companies like this that we can buy control of on a friendly basis. Keep your eyes open, Warren. So today, I thought I share some case studies of, companies, dominant companies that today are giants, but what we can learn from the early days. So I'll just flip through some slides on case studies. The first slide here is a filing excerpt from McDonald's in 1965, right? This is a long time ago. But McDonald's was a fast growth company, even back then, with a significant real estate portfolio. If you follow this excerpt, here is Ray Kroc. He says, we are committed to finding something that the public wants that is simple, that can be sold in volume, and consistently good value, right? He says, to millions of modern Americans, a world without the McDonald's hamburger is as incomprehensible as a world without television. So when an investor was looking in 1965 and reading this, here is a great business with significant real estate investments. And going to the next slide, here you see the fast revenue growth that McDonald's was actually experiencing. If you look at the total sales, all units, you see the company grew from 76 million to about 218 million between 1962 to 1966. And on the right-hand side, you see the significance of the real estate portfolio, which has played a significant importance in McDonald's strategy. Moving to the next company, Chipotle. On the bottom left, the company talks about, we do just a few things, but try to do them really well. So they're focused on a focused menu to the uncomplicated flow of their stores and keeping small inventory. So that's what they're focused on, taking a simple idea and taking it very seriously. Again, if you look at the income statement here on the top left, you see Chipotle has grown revenue significantly very fast from 2001 to 2005 and still was in its early growth years. Investors would be well paid to have paid attention to Chipotle's simple idea and take it seriously. This is Coca-Cola. In 1987, it was a $14 billion market cap. Today, $300 billion. Back then, 524 million servings a day were consumed, which was 2x the volume to its nearest competitor. Today, Coca-Cola sells 2 billion servings a day. As you can see on the bottom left, net operating revenues of approximately 7.7 billion. It was earning returns on equity in excess of 50%. As you can see on the chart on the bottom right, you see fast revenue growth. You see fast, growth in profits. In fact, the next slide shows that cash flow exceeded 1.2 billion in 1987, doubling in 2 years, and they were reinvesting this cash flow at high attractive rates, as demonstrated on the right hand side of the slide. They were also repurchasing stock, 10% of the entire market cap in those years. And so the point I want to share is that Coca-Cola at that time, had significant global growth opportunity, was buying back its stock, had high returns on capital, and had a product that was simple and easy to understand with excellent brand recognition. This is Fair Isaac Corporation, or FICO. It's a royalty-based monopoly business. I pulled up a 2001 annual report of FICO, and the company had just topped $1 billion in market cap. Many technology businesses were collapsing at that time. It was the peak of the dot-com bubble. But as you can see on the bottom left, FICO's revenues grew from 200 million to approximately 330 million during that time when many technology businesses were collapsing. So again, because of this royalty-based monopoly business, and it has continued to experience very significant growth. The key products and services the company sells are on the right hand side. And so the next one is Nike. You might be surprised to know that in 1980, Nike only had about $2.7 million in sales. That's it, right? It was experiencing, again, very fast growth, about 4.6 million revenue in 1981. I think what's brilliant about Nike back when it was an early growth stage company was it adopted brilliant marketing strategies, honoring great athletes like Carl Lewis's 28-foot long jump, honoring John McEnroe, etc., and using really this, honoring great athletes to really cement its branding and marketing. And the company has grown from 2 million revenues to over 50 billion today. And so many of these ingredients really were laid out in early filings where, investors could actually witness a fast growth, witness a keep it simple strategy, witness sort of the very brilliant marketing, and Many of these companies actually were generating internal cash flow. This is a more controversial company, BYD. Today, we know it as the dominant new energy vehicle globally and particularly in China. But when BYD pivoted from making Nokia batteries, in the very early 2000s to car batteries, the market crashed the stock, and the stock, I think, fell, or in excess of 70% during that period. Of course, it coincided with the SARS crisis. The company, as you can see on the filings on the top left and right, the company says, while this is from the 2002 annual report, the company says while focusing on its core batteries business, the group is exploring the potential of other products, which is new electric motor vehicles. And so they made this acquisition. And they go on to say that the growth potential for EVs and automobile is enormous. The market didn't like it at that time. The stock got trashed. It was in the hands of BYD. Was founded by Wang Chunfu in 1995 at the age of 29, an exceptional operator. I digress a little bit, but this is a slide which talks about the importance of temperament in investing, especially if you're investing in a great business run by a great founder. BYD has fallen 50%, 6 times in 22 years, and the stock has fallen 80%. At least once during that time period. Li Lu of Himalaya Capital fame was an early investor in BYD. And so the point here is really when you're invested in a company with enormous growth potential and run by a amazing operator, your circle of competence is going to be tested by the market with stock declines. This is Microsoft in 1985, almost 50 years ago, 40 years ago. Microsoft, as you can see from its filings right here, had $140 million in revenues in 1985, growing from only 24 million in 1982. It was profitable even at the time of its IPO, and it was run by its obsessed founder, Bill Gates. Really, again, there for investors to see. Investors had the ability to judge Bill Gates. And the point I want to highlight from many of these businesses is they were great businesses even back then, experiencing growth, focused on its core product, a simplicity in its business model, significant operating leverage, run by a founder that was extremely focused. The next one is Costco. Folks, especially in the United States, would be very familiar. It's a part of American culture. But Costco really delights its loyal members who've been growing over time, as evidenced by the top left membership chart, generating high sales and rapid turnover of inventory at very low prices, similar to the Amazon model. Since 1991, the operating cash flow has increased from nearly 380 million to nearly 10 billion. So again, simple model, low prices, high rapid turnover, generating high sales, delighting its growing and loyal member base, where, really Costco makes money from its membership rather than just selling its inventory. A very clever model. This is some of the charts from Walmart's 1980 annual report. As you can see, significant growth, net sales, total square footage, net income, stockholders' equity. It was clearly a growth company through its 1970s, 80s, and had returns on equity of over 30%, while growing revenues to over $1 billion by 1980. And you might have thought, okay, well, it's at $1 billion. How much further could it grow? But, the companies kept growing to become one of the largest companies in the United States, while the founders have retained significant ownership. Again, following the same playbook of, early growth, internal cash flows, executing a, superior execution run by founders that were truly obsessed by, being the very best they could be. This is a slightly more controversial one. Netflix actually, you might not be familiar, George, but it started as a DVD rental business. Streaming came later, right? So in 2002, and for a long period of time, investors on Wall Street were very skeptical of Netflix's model because, the company was not positive cash flow generating, at least on the free cash flow level. But here, the company says in 2002, we anticipate hitting the 5 million mark this year, a full year ahead of our expectations. In 2005, when we said we would reach 20 million subscribers in the next 5 to 7 years, there were again doubters. So the company throughout its history or the very early stages for a good decade and a half really faced significant doubters all along, but was very focused on its core. At the time, given technology, DVDs were a core part of kind of its strategy. But as they built this happy customer base, they were able to, pivot later to streaming. This is American Express, Amex in 1964. The company, prior to the crisis, the company faced a crisis around that period, the salad oil crisis. The company had already paid 95 consecutive dividends. This is the longest investment for Warren Buffett. He bought the business when it went through this temporary crisis. So it was a wonderful business at an extraordinary price due to the salad oil crisis. But it had already paid 95 years of consecutive dividends. It was a clear track record and clear, growth trajectory, in its core business. Some of my favorite letters are the ones by Amazon, Jeff Bezos. Here, there's a snippet of a annual report which talks about Mr. Bezos's fixation on long-term orientation and emphasis on cash flows, right? I remember I got my career started in at the peak of the dot-com bubble when Amazon stock had declined 90%. And even amidst those turbulent times, which I remember well, the focus by Jeff Bezos, and that at that stage, Amazon was a very early growth company, was really focused on long-term thinking and optimizing cash flows instead of gap accounting. And it's very clearly highlighted. So the playbook has been consistently clear across many of these case studies. The next company is Taiwan Semiconductor Manufacturing Company, TSMC. This company, as indicated by the table on the right, has generated positive free cash flow every year since its IPO. The company's share grew to over 50% by 2005, delivering higher operating profit than the rest of the competitors combined. So again, a track record of execution, track record of growth, run by, again, founders that were very focused on one mission. This is an Indian company, Infosys, and I only point this out. There's plenty of Indian examples to talk through, but I just picked one because there are so many. But Infosys every year on its annual reports very early on, 1999, etc., when it was a tiny company, they announced awards for excellence, incentivizing employees with recognition in stock. At the time, not necessarily very typical for an Indian company. As you can see at the table on the top left, the company growing revenue at 80% with the advent of the internet and global role that many Indian companies played. With IT and outsourcing services, revenue was growing at 80% with very high margins and very high returns on equity. But the incentive system early on, I think, was very interesting. So let's summarize here, George. What have we talked about? We've gone through a few case studies of, obviously, hindsight is 20/20, and some of these examples are in hindsight. However, we can learn from them. There are some there are some commonalities between many of these great businesses. Many of them had recurring revenues. Many of them had a simple idea and they took it seriously. So you keep it simple. Many of them had scalable business models, right? They had achieved in many cases, billions of customers, right? Like McDonald's had billions of servings, Coca-Cola, billions of servings. Um, Flexibility. Some of these businesses demonstrated flexibility as the world changed. They adapted, right? Like Netflix, from DVD to streaming, Amazon from books to AWS, from BYD, from mobile batteries to new energy vehicles. So there was a pivot from some of these companies. The people in matter tremendously, as I mentioned. There was founder obsession. Uh, would say was uh, innovation was part of the underlying thread. Globalization with localization, adapting as you grow globally, you have to adapt to local markets. Um, Next, operational efficiency. These companies were ruthlessly focused on lowest cost advantages and operating as efficiently as they could. Word of mouth. I mean, these are well recognized brand names now, but when you read the filings early on, it is quite clear they very significant customer penetration and word of mouth and customers who were delighted. And finally, and most importantly, a large number of customers to cross sell as they pivoted into newer markets or newer product segments. So these are some of the ingredients that some of these case studies highlighted, right? So I'm happy to take questions now from you, George, and we can dive deeper into investing, career, and any other topics you have in mind.
Thank you very much, Sid, for the incredibly insightful presentation. I know that I personally got a lot out of it regarding your philosophy and some of the companies you've covered in your time as an investor. And I know that our members nationwide for unit will get a lot out of it as well. With that in mind, as part of the Fireside Chat, Sid, for the benefit of our members, we do have some questions on investing, on leadership and personal development, and on your own career path that we would like you to answer. And I know you do have some interesting answers for just regarding your journey and perhaps some advice as well for our members. So we're going to start with some investing questions, Sid. And to start off with, would you mind sharing with us how has your investment philosophy evolved over time and what experiences have shaped your approach?
Yeah, thanks, George, for that. I'm glad you enjoyed the presentation. So I started investing at the peak of the dot-com bubble in April 2000. My market timing is not exactly excellent because at NASDAQ subsequently plunged 78% over the next 16 to 18 months, and stocks like Amazon declined over 90%, and a lot of the high flyers of that generation went, belly up. So it was an eye-opening experience, George, on market bubbles and stock market mania, right? During the 2008 global financial crisis, I was an analyst then at Merrill Lynch, which was an iconic American firm. The event itself was a 1 in 50 to 100 year event. So I learned a lot about Wall Street folly, and there's certainly a lot of it, and the importance of downside protection in investing, because just when you thought stocks wouldn't fall, they fell another 50% and they kept falling. So let me share a few overarching points, building on from that presentation. Great ideas are rare. You want to fish where the fish are. There are approximately, I think, in my view, 140 to 170 businesses worldwide, which is less than 1% of the 30,000 listed businesses that merit close attention. First, what should an investor look for? You look for companies with nonlinear patterns run by founders with no distraction, and this is their life mission. And the goal is to find them before institutions. There is pattern recognition, and I think an investor ought to focus on that. And that's what I focus on. The second is you study great entrenched businesses. put a price to buy. Typically 95, 98% of the time, George, many of these entrenched businesses are fairly overpriced. They are not in the right strike zone. During a crisis, great opportunities typically emerge, and that is when it's most uncomfortable to buy, but that is the period you want to act fast. If there's really nothing smart to do, George, I do nothing. The third bucket is really hated or unloved businesses where investors are fleeing and the source of mispricing can be rather large. The question then is for me to answer, is this a temporary or a permanent change in the business economics? I want to add a few more points on, the importance of studying history and being open-minded with a ton of humility. If you look at investors indexing in the early 1970s, they underperformed US Treasuries for 29 years. I think today investors are too complacent. The Nasdaq actually went nowhere between 2000 and 2014. Japan, the market went sideways or down for about 30 years. The same thing with China for about 20 years. So everything has a cycle, and I like to study history and cycles to understand, market psychology. You want to avoid the hottest stock in the hottest industry. It's fun, but it does not last. Next, when everyone hates something, it typically deserves a lot of attention, and something I like to focus on, being contrarian. One lesson I've learned, George, is to beware or ignore the backward sexy numbers trap, which is ignore trailing multiples. They tend to be highly misleading. And finally, I would say you don't get rich buying 5 times earnings PE stocks going to 8 times. You are really looking for those companies that can go from 5 times to 50 to 100 times.
Very interesting, Sid, and I appreciate your insight there. Our next question for a lot of our members who perhaps be it for their own investing or perhaps for a career in finance, a lot of our members nationwide would have taken on an interest in valuation, be it in the classroom or outside the classroom. We just wanted to know a little bit more, Sid, about how you personally, as an investor, approach valuation of a business.
Yeah, this is a very interesting and very important question. Business schools, in my view, teach valuation wrong. There is too much focus on the tools and not enough focus on independent thinking. So it tends to lead to herd behavior on Wall Street. First, George, valuation depends on what game you're playing. Are you an investor in the public markets, credit markets? Are you a venture capitalist? Are you an investment banker? Or are you a distressed investor? In venture capital, valuation is not a consideration. They tend to be very, very, very early stage companies, and VC investors tend to run a very diversified portfolio. So they're fine with an investment that they make that goes to zero. But missing the big wins is a no. So there's a bit of fear of missing out, or what, market participants call FOMO. In the credit markets, downside protection and balance is key. So certainty of cash flows and analysis of balance sheet analysis becomes very significantly important. And therein, valuation is extremely important in credit investing. In the public markets, which is a space where I'm active, assuming that one has a more focused, concentrated portfolio, one cannot, like VCs, afford to have zeros in the portfolio. And their valuation does become quite important. My simple philosophy is if you can't predict the economics of the business 5, 7, 10 years later, you have no business valuing it, right? So there's no point spending time valuing a business which you cannot predict, because as you know from the discounted cash flow, George, most of the value of a business comes from its terminal value. I want to add another point on valuation on PE ratios, price to earnings multiples. They're highly misleading if you do not know the limitations of a PE ratio, and there are many limitations. Amazon, for example, had a 600 times PE ratio just 10 years ago in 2014. The stock is up 10 times since. So someone just focused on the trailing PE ratio would have totally ignored the stock. Google's trailing PE ratio at its IPO was 80 to 120 times. So someone just focused on that would probably have missed it, and the stock is up 70, 80, 100 times since. The Microsoft in the dot-com bubble, which is 2000 April, was trading at a reasonable PE valuation of 25 times. It seems okay from a headline compared to Amazon and Google, but Microsoft stock from 2000 to 2014 or 15 essentially was lost cause. The stock went nowhere despite trading at more reasonable valuations than Google and Amazon. The big point I want to make here, George, is that something growing predictably, like Amazon and Google were, at 20 to 25% or more, yet trading at higher trailing PE ratios is much cheaper than something growing trading at 20 times, but growing at 5, 6, 7, 8%. So let me close on this particular valuation topic with a few other thoughts, George. Math alone is not an edge in the markets. It's critical thinking and judgment, that is. Everyone now has a calculator or an Excel sheet and now AI tools, which can do the work for you, right? We've had this zero interest rate environment for too long from 2009, where price did not matter, valuation did not matter. But in a higher rate environment today, cash flows today are more important than the distant future. Valuations typically tend to re-rate with higher growth, cash flows, and return on capital. Those are the three key variables along which you value a business. And all things being equal, companies with high capex, they tend to trade at lower multiples. And as we've seen some of these bigger tech companies now making significant capex investments in AI, typically high capex businesses tend to be low multiples. So the final idea really, George, here is that for valuation, you want to be roughly right in the ballpark zone, then completely wrong. And it depends what type of an investor you are, whether you're a VC, private equity, investment banker, or public markets, looking at PE ratios, etc., highly misleading. And it's really your ability to predict these variables, growth rates, returns on capital, cash flows, that are going to be significantly important.
Very interesting. And yeah, thank you again, Sid, for your insights into valuation. Another question on the investing side of things as well, which I think a lot of our members will get some serious use out of, Sid. How would you say one stands out in an industry like the one you operate within, where the reality is it's filled with so many brilliant minds, it's filled with so many outstanding people? How would you say one stands out personally?
That's a great question, George. I think most investors are their own enemy, or the competition is yourself. The competition is not typically with other brilliant minds, although it might not seem like this at university, looking for jobs, etc. But you are right only if the facts that you put forth are right. Mr. Market does not care how brilliant you are. Mr. Market does not care what great schools and firms you worked at. You're really right if your facts and reasoning is right. So for example, Bill Ackman, who's certainly a great investor, sold Netflix, one of the case study companies we talked about, in 2022. The stock has since returned 6 times in 2.5 years, right? So in this particular case, the facts, were different from Mr. Ackman's thesis. The brilliant minds of Wall Street got 2008 very wrong, leading to Bear Stearns, Lehman, and Merrill iconic brands taken over. So the point I want to stress here is you're right if the facts are right. The biggest enemy is likely yourself. So my strategy is to just focus on being the very best at the game that you can be authentic, turn more rocks than anyone else. The great ideas will stand out, and be independent. Investing is not a team sport, unlike some other professions.
Awesome. Thank you for that, Sid. And yeah, agree with a lot of the points you make there on being yourself, especially. There's some serious value out of that. Continuing on the investing front, how would you say you manage the psychological challenges of market volatility as an investor?
That's another great question. So psychology, I believe, is more important than accounting or brilliance or pedigree, right? The stock market is a place of regrets, George. An investor sells the stock too soon, you regret. You bought too little of the stock, you have some regrets. You sold too late, you have regrets. Or you bought the wrong company and or someone else, your friend, made more money, right? So there's a Mr. Market is playing games with you. It is futile to check the portfolio daily. It gives you a false sense of control, right? There's a wise saying, not everything that can be counted should be counted. So today we're assaulted with new information. This gives us a grand illusion of control, which is quite the contrary. There is really no control. So the more you look at the portfolio, the more you look at its daily stock prices, the more you tune in TV channels, media channels, the more you see the news, the more you see your losses and gains, for example, or in the case of losses, there is this characteristic called myopic loss aversion. So one is likely to avoid pain of loss the more you're aware of the loss. So my focus is simply to focus on valuing businesses in my checklist one by one and putting a price. And if there's nothing to do, there's nothing to do. So you cannot control what the stock market does tomorrow or next month or next quarter. You just simply focus on tuning out the noise and focusing on the systems and processes.
Again, yeah, thank you again, Sid, for that insight onto the psychological side. And then to wrap up the investing questions on our end, would you say are some of the biggest challenges and opportunities for investment managers today from your perspective?
So I don't attempt to actually predict levels of the market where stock markets are going to be. There's always something to do. But let me make a few observations on opportunities and challenges. In terms of opportunities, George, I think we're living through some really exciting times with the advent of artificial intelligence. I think these are really some exciting times, and there's going to be lots of disruption ahead. A lot of businesses with strong competitive advantages, the old moats, may likely disappear. There's going to be significant breakthroughs in healthcare, tech, education, productivity, defense, robotics, and so lots of new opportunities are going to emerge. And I think that for an investor, the key question is which companies are going to benefit from that trend, and which companies are going to get massively disrupted because there's going to be a lot of them. The energy sector, there's going to be significantly important as part of this artificial intelligence equation, requiring lots of energy and investments there. Another opportunity is that in this era of zero interest rates that we've seen for a very long time, the rising tides have lifted all boats where price did not matter, right? Alluding to your previous question, I think we're now entering a period where stock picking is going to be really important. In terms of challenges, George, the world was a very different place from before you were born. I think in terms of globalization, there were three key trends. Globalization was one. There was more trade, open trade. There was very low interest rates for a very long time. Essentially from 1980 onwards, you've had low interest rates, and then you've had low inflation for 30, 40 years. They've all benefited investors. There's been a significant tailwind. Now we're witnessing the opposite. You're witnessing deglobalization with tariffs and trade deals. You're witnessing a move to higher inflation, right, with all this money printing that's happened over the last 15 years. And you're going to have to witness higher interest rates. So the reverse is happening, is deglobalization, higher interest rates, higher inflation, and potentially the dollar status as a reserve currency, is gonna be some questions that investors are gonna ask. So there's plenty of opportunities, plenty of challenges, but really focus on these great businesses uh, is going to lead to, great results.
That's awesome to hear. So yeah, thank you again for that analysis on some of the challenges and opportunities for investment managers. Sid, if you don't mind, we're going to move on from some investing questions to a bit of a different theme, but one that's going to resonate with so many of the people who will be watching on, and that's regarding leadership and personal development. Of course, over your career, you would have seen many leaders, you'd have experienced a wide range of types of leadership. So for us, some of the questions we have in mind that we think would be most useful are on that topic of leadership and personal development, so our members can help develop their skills in this area for themselves. To open up with Sid, I'm going to ask, what habits would you say have had the greatest impact on your effectiveness as an investor and otherwise?
That's an incredibly important question, George. I think habits, not motivation, decide your future. I really view life in three buckets, right? Or life of my day or my week. It's investing, health, fitness, and key relationships. And you got to time block for these key activities and prioritize, right? So let's discuss the first one, which is investing. We talked about the use of checklists. We talked about the relying on proprietary databases and systems heavily in my process, reading a new annual report every day, turning rocks, take a simple idea and take it seriously 6 days a week, make it a daily habit. Second, health and fitness. This is also a non-negotiable. I time block for fitness activities, CrossFit, strength training, walk 15,000 steps, 5 days a week, typically about 7 miles with a weighted vest. Now, why? Why is that important? Well, it's important for fitness, but also in investing in the compound interest equation, time or T is the most important variable because the longer you compound, at high rates, but the determining factor is time. So the right habits will determine your health and fitness. I once met a billionaire for a coffee who needed, sadly, regrettably, needed help to walk in his 50s, late 50s. So the question really is, what is the point? You're going to be money rich, but health and time poor. So the third bucket is cultivating strong networks and relationships, which you're learning to do at the University of Melbourne and your members are. Really, so the way I do it, but as you have a longer career, you start to develop a lot more relationships, a lot more networks, and utilizing them more effectively starts to become a challenge. And so what I do is I log the key relationships with people in a CRM I've developed. And I typically say no to most meetings. If necessary, they can be turned to calls. And, I'm a big believer that you're the average of the top 5 people that you hang out with. So if you want to be a great investor, you surround yourself with them. If you want to get fit, you move with them. And I sort of maintain this CRM database of my key relationships so that when I'm doing due diligence on a company, I can reach out to the relevant people in a very timely manner and fast track my research. So habits are a key part of any successful person, whether it be investing in life, with people, relationships, a topic I take very seriously.
Awesome. Thank you for that, Sid. And sort of building onto that as students look into developing their careers, another question is, what are some of the less obvious traits that you've observed in individuals who go on to build extraordinary careers? Not just the stuff that people would think of first and foremost, but some of the less obvious traits, Sid.
Yeah, I think the most important one is resilience and grit. You can't beat someone who refuses to give up, right? So Charlie Munger, legendary investor and partner to Warren Buffett, had lost his marriage, lost a kid early on, lost his eye, almost went broke, But he kept learning and he kept going on. So I think resilience and grit is number one on my list. But a few other traits I think that are more important, that are also equally important, George, authenticity, right? I think there's too many people or even students or even investors are not authentic and they go with the herd behavior. What is popular? My suggestion is this is your life. You got to own it, right? Like you got to own your own journey. So be authentic. Second is routines. We talked about habits, right? You got to master the boring stuff first before you take on the exciting stuff. If you only get interested in the exciting stuff, you're never going to be successful. Isaac Newton isolated himself for hours and days, sometimes for deep focus. Any of the geniuses or innovators in the world. Kobe Bryant practiced at 4 a.m. when his competitors slept. You got to focus on the process and focus less on the outcome. Because when you're focused only on the outcome, you're focused on the reward and not necessarily the day to day. Learning from failures is critical and very important. Thomas Edison recorded failures I've read in 3,500 notebooks before he was successful, right? Time management is critical as skills you learn at the University of Melbourne, but it's a finite resource. You only have so many hours, and that is time that you cannot get back. So you got to have really good time management skills. And finally, I think this is very important, is practicing long-term thinking in every habit, everything, whether it's investing, whether it's your fitness, whether it's your relationships. People that practice short-termism in their lives usually feel good initially, but over a long life, things catch up with them. So those are some of the key traits that I think are really important. Top of my list is grit and resilience.
All right, that is awesome to hear again, Sid, and something that I know a lot of our members, as well as myself, will find really valuable from the discussion today. One last leadership and personal development question on our end. Now, you've of course been actively involved in mentoring and speaking at top universities all over the world, as well as the ones, of course, I'll be joining for the call today. I'm just very curious, what motivates your commitment to supporting the next generation of investors?
Yeah, well, I have a few points here. First, the best way to learn is to teach, right? Like if you can't teach a subject in a very succinct, articulate way, you don't really truly know the subject, right? I am forced to articulate and simplify some of my thoughts, and this helps me confront my own gaps. And I find that a very interesting process. Second, I learn from the new generation. The older generation has blind spots to new themes, and you are the future, right? And so what better way to give back while learning? I tend to keep these relationships for, especially with talent. Finally, the point I'd like to add is I sometimes spot passionate talent about investing and they turn into long-term relationships, lifelong relationships. And many of these calls that I've had with many of the universities, I'm in touch with, many of the kids, and they've gone on to do some really interesting things. And they are now a core part of my network. So they turn into lifelong relationships. Some of my interns have gone on to have vastly successful careers, both on the investing and corporate side. So there are a couple motivations, but I think the first and foremost is really the best way to learn is to teach the subject. And I think once you're teaching the subject, you're trying to, become an expert at the topic.
Awesome. And yeah, thank you for that, Sid. And yeah, we do appreciate your commitment to supporting the next generation of investors, be it at the University of Melbourne, across Australia, or otherwise. To stay on a similar tangent to some of the leadership questions that we were just asking, we're going to move on to some more career path focused questions that we think a lot of our students around the ages of 19 to 23 or so on the call will get a significant amount of use on. Of course, you've had a storied career within finance and investing. So looking back to start off with, what would you say, Sid, were some of the most pivotal decisions or experiences that shaped your early career?
Yeah, I think the first point is you pick something you truly love is really important, right? You got to play to your strengths because if you love the process, you're going to work harder to get better, and this increases your probability to be in the top of your field, right? Conversely, if you don't love what you do, if you're not playing to your strengths and you just take up something just because it's like sounds prestigious or is going to pay you a lot of money initially, what's going to happen is you're going to give that up inevitably when rough periods hit because you don't actually love what you're doing and this is not your forte. So I consider one of the most important things is just getting on the right seat, which is kind of what you love to do, right? So I consider myself fortunate to stumble onto something what I truly loved. Sort of early, even in my university days, I had an internship um, with a generous investor who taught me the trade, and this was amidst this dot-com bubble. So most people never really find what they love. They go from job to job thinking that it's a checklist, checkbox without finding their passion. So for me, I think that is really, a pivotal decision is truly just getting in the right seat and what you like, right? For me, the early experiences also of investing or seeing these cycles, the dot-com bubble when the Nasdaq fell 78%, and previous high flyers disappeared. Then I saw the Enron financial fraud. The 2008 financial crisis was a 1 in 100 year event. And just going through that in my sort of, very early 20s and mid 20s sort of prepared me to have my eyes wide open to a range of outcomes, to be more flexible, to be more humble, and sort of, continue that learning process.
Awesome. Yeah, thank you for that, Sid. Very interesting. And then another question as well. Again, a lot of unit members nationwide will have an interest in breaking into the buy side. So we wanted to ask as well, what advice would you give to students who are set on breaking into the buy side? And on top of that, of course, given your career, Sid, do you believe that investment banking is the best starting point to support that goal? With the caveat that that is something that a lot of our members are probably thinking about now as they think about how do they want to approach their career.
Yeah, no, that's a great question. Working in investment banking at Goldman, post my MBA was a fantastic experience. And I worked in Merrill Lynch prior to that, also in the sales and trading side of things, working closely with the investment banking. So it was look, Goldman was a fantastic firm, culture, and I made some lifelong friends with incredibly smart people who are now, many of them are on the buy side. And so, this being said, the nature of banking is slightly different from being an investor, right? They're different seats. Yes, investment banking prepares you to understand, financial modeling, presentation, communication skills, working extremely hard. It does open doors because there's alumni from these firms. That being said, I don't think it is a requirement, although funds and certainly PE funds, value the background. I don't think necessarily it's a absolute requirement, right? Like Warren Buffett or Charlie Munger were not bankers in their career early on. Neither was Lee Lu, who runs Himalaya Capital fame. And so are many of the best investors. So I think if you want to be contrarian, it's okay to go work for a real business, right? Learn how to manage clients, cash flow, inventory. It might actually teach you to be a better investor. However, there is no one path. I think investment banking does provide you some solid training. And for people that are not very clear as to kind of what they want to do, I think it provides a wider range of options, whether you want to be an investor, private equity investor, or go into the corporate world, or even, go into other fields. I think it prepares you for that. So, I think no one set path, George. And I think the most important thing is sticking to your strengths and loving kind of the seat that you eventually end up in.
Awesome, Sid. Thank you for that. And then one last question just to close it out regarding the career path you've taken and advice you have. How would you say young professionals should approach the trade-off between optimizing for learning versus compensation in their 20s. Again, given the crowd that we'll be speaking to today, I think it is a very worthwhile question and something that a lot of people are going to be thinking about as they approach their future careers.
Yeah. No, this is a great question. It's really important. I think very early on, the most important thing is picking the right field with the largest growth potential. And then within that field, you want to work for the very best in the field. That's the most important thing, in my view. Now, compensation is clearly important, but it's one variable in a multivariable equation, right? So at the same time, only accept lower compensation if the role offers at least 5 times the learning velocity of a higher paid alternative. Do you understand? So there is no like right or wrong answer. But if the role offers 5x the learning velocity of a higher paid alternative, then that is a consideration. So high salaries sometimes can trap you into a too narrow field depending on what people are looking to do. If they're going into a very narrow field of finance, it can limit skills and opportunities while providing a higher salary. So I see young kids sort of working at, in areas that sound glamorous, but then what happens is they sort of are in a very narrow field, and that leads to, a different career path. So I think the goal, especially early on, is to find, what you are truly love, find the seat, and, even if it doesn't pay much, if the mentor is fantastic and you're working for the best, I would prefer to take that sort of role. So the goal is to balance learning and earning to structure your early career so that by the age of 35, you can be free to pursue your personal and professional interests. So that's how I would answer that.
Thank you very much for that, Sid. With that in mind, that concludes the questions we have on our end as part of the Fireside Chat. So that concludes today's presentation. So Sid, on behalf of myself, but also unit members nationwide from numerous chapters, not just the University of Melbourne, I wanted to thank you very much for your time and your insights. Again, this will be available on platforms for unit for our members nationwide to view. So we're very appreciative of your time joining us from Washington, DC. And again, yeah, thank you for everything that you have shared.
No, thank you, George. And I'm glad, if students find this helpful, they could reach out to me. I'll share my contact details with you, and I look forward to staying in touch. Good luck.
Thank you, Sid.